A wave of pessimism over the outlook for U.S.-China trade talks has infected financial markets this week, with risk appetite coming off in a big way as a result. After pushing up to record highs in the previous week, the S&P 500 has reversed course quite sharply, though already, even without the hiccups on the trade front, this market continued to look highly extended a decade after the 2008 crisis. There are other factors at play that should not be dismissed, not the least of which the reality that with monetary policy already exhausted post-crisis, there's very little room for central banks to move should that next crisis come round. Today's RBNZ rate cut was a reminder of the state of things, with the central bank unable to follow through with its own policy normalization trajectory, instead sucked back into needing to accommodate again. This is symptomatic of what we're seeing at the major central banks around the world and should be a worrying sign for the global economy. Elsewhere, faded prospects for a Brexit deal ahead of EU elections stoked renewed Brexit worry, though we believe this reaction of selling in the pound is overstated. Absence of first-tier data on today's calendar will keep market participants focusing on these bigger picture macro themes. The euro has done a good job holding up, while gold is clearly in season in light of the risk liquidation. Of course, it isn't surprising to see demand for the yen and Swiss franc. If the U.S. administration continues to press in this direction, we might expect more outperformance in the major currencies relative to the U.S. dollar, given U.S. dollar bearish implications from U.S. administration trade policy. Meanwhile, Bitcoin has done a fantastic job holding up, not only in the face of the setbacks in the global economy, but also after taking in the news of a $40 million Bitcoin hack at a major exchange. ECB Draghi will be on the wires later today. That's all for now.